Welcome, guys, to another episode of Kuvera Insights, where we bring you thought leaders to discuss about personal finance. Today, we have two very special guests, both born abroad, work in India. They have lived internationally, and they understand investing from both a global perspective and an Indian perspective. So, introducing Radhika first. Radhika is the CEO of Edelweiss Asset Management since 2017. She previously worked with McKinsey, the quant fund AQR, before she started her own venture, Forefront Capital, which was acquired by Edelweiss in 2014. Radhika is a graduate of UPenn, did a dual degree in economics and computer science, management and computer science. She's a member of the Amphi board and a member of the Young Presidents Organization, and was recently named as 30 most powerful women in Indian business by Business Today. So welcome, Radhika.
Thank you.
We also have Una with us. She's an associate editor at Reuters Breaking Views, based out of Mumbai. She was previously in Dubai covering the Middle Eastern economies. During the Arab Spring, that would have been a fun experience. She joined Breaking Views in 2006, writes about capital markets and M&A across Europe from London. Her column on Goldman Sachs' relationship with IMDb, 1MDB actually, IMDb is totally different, sorry, 1MDB, won the award for the best editorial comment at the 2016 State Street Institutional Press Awards. Welcome, Una. So, I mean, actually, it's amazing that we have a panel that's completely international. I mean, you guys have both lived and worked abroad. You're now in India. So let's start with, the big question. There's been massive liquidity that has been unleashed globally by central banks. India has not done the same in terms of the GDP size. Is there an expectation that this liquidity, which is squashing around the global markets, will eventually come to India, which will eventually come to EM as it did in 2008? And Una,
well, I'll start there.
Yeah, please.
Yeah, I mean, I guess my short view is that, yes, it will come back. But I think capital in the post-COVID-19 world is going to be much more discerning. So in 2008, 2009, the narrative was quite simple. The US, the Bank of Japan, and others were, ultra loose monetary policy, excess liquidity. Investors were seeking higher returns, and then, but the GFC was a narrower event, right? And so capital was able to flow back because that event was managed quite well in the Asian markets. I think that virus concerns mean that things will be quite different this time. I mean, if I can explain why, I mean, I think that a market's attractiveness is going to depend a lot more on that market's ability to manage this virus and health crisis. And why is that? That's because currently all this, demand crushing stops and restarts that we're having, it's more likely to see that in a market that hasn't been able to handle this health crisis well. I mean, and we're already seeing some evidence. So like the EM money that flew out, I think we saw $83 billion of outflows in March, and then this money started coming back in April. But that money was mostly skewed towards emerging Asia over LATAM. And it was within emerging Asia, it was mostly skewed to markets like China and Taiwan that have really handled this crisis well. So I think that money will come back because it's inevitable. People want yield, and you're going to get higher yields in emerging markets. But you also need the performance of those emerging markets is now very, very closely linked to how they manage the COVID-19 crisis.
So Radhika, specifically for India, what does this mean then?
So I think
India
India,
a big driver, right? So how does that, help or hurt us?
so you get this question a lot, Gaurav. I mean, every retail investor seminar I do, the first question is, what happens to my money because of FII flows? And, quite frankly, I think for the average investor, that question may or may not be relevant. I think Una made a very good point that India will attract capital on India's merits. Capital will come back to emerging markets. How much comes back to India, I think beyond the point should not affect domestic investors. I will say that domestic investors over time in an Indian context have become more significant. So if you look at versus 5 years ago, and the SIP book size we have today, domestic retail capital has become a larger part of our market today. In fact, FII ownership has come down. So that's just something to keep in mind. Recall there is also some change that the government has made in terms of approvals at an FII or FDI policy level. So that's just something to keep in mind. But domestic capital has become more significant. I also agree with the sort of opening comment that you made that in case of the US, it's definitely a market that is flush with liquidity. And, you know, when rates are zero, asset prices are naturally supported. India doesn't have that benefit. So that's also something that domestic investors have to keep in mind. I mean, it's just a reality of our conditions. And you're also living in a world, Gaurav, I'm sorry to interrupt, you're also living in a world where post-COVID, and actually pre-COVID also, but I think this has been accelerated post-COVID, localization in favor of globalization, people are becoming more insular. Every market is becoming more insular. If you look at the US and if you look at a lot of the Trump policies, if you look at Germany, if you look at what India is saying around Atmanirbhar, everybody is suddenly becoming a little more insular because the first responsibility is to protect your domestic consumption, your domestic worker base, your domestic market. So everybody is also becoming a lot more insular. I think that's just something that you have to keep in mind.
Which is really interesting because actually what you're seeing now globally, I mean, one theory, of course, is that large domestic markets, consumer-driven markets, China, maybe India is part of that, let's see, the US will rebound faster than these small outward-facing city-states, be it Hong Kong, Singapore, Dubai, because the domestic market is so important to like propping up demand, both in terms of like buying and, as you said, like domestic investors have just become so sticky in the market in India now.
So fair enough, but you know what we are also seeing, especially in India, that there is a huge demand for Indian investors thinking about global investment, right? So I understand that the government level, yes, there is some insulation that's happening, right? I mean, every government has an almost an obligation to kind of protect their citizens first. I mean, that's what the government is for, and to ensure that their economy is protected. So to some level, a lot of the government actions will be protectionist in that sense. But in India, we see this, right? And Radhika, I mean, you can also talk about it. We see this a lot, that people are suddenly very interested in global markets, right? There's a lot more products that are available to invest abroad. There's LRS, there are mutual funds, there are single stock platforms that have come up. So why should an Indian investor think about international investing? What's driving this, that suddenly the Indian investor is becoming like, okay, I want to own Chinese stocks or Hong Kong stocks or US or Europe. So what's driving that behavior?
So I think Gaurav, it is good behavior, net. And I think the point that you made, you know, regardless of what's going on in the global backdrop, India is a market. So I lived overseas, and when I invested and most of my friends invested, you know, we didn't carry the amount of home bias that there was in India. When I was living in the US, probably 50% of my equity investments were outside the US market. Now, historically, the way we have been in India for whatever reason is that 80, 90, 100% of our investments have been in the Indian market. I think as India matures, this is a natural change. So I think looking at international investing, regardless of the economic backdrop, is a very good thing, because as Indians, we have been underallocated to overseas markets. In fact, we've been over home biased. I think for an Indian investor, why people are looking at it, quite frankly, is probably, I mean, I hate to say this, is probably recent performance of these markets relative to Indian markets. And also, I think there are stories that people can relate to. You know, when you talk about a theme like technology, for instance, I mean, we use and feel these technology companies, so it feels real. When we talk about China, for instance, it's a market that, everything said and done, resembles our own market in terms of consumption. So it feels closer to home. And I think there are 3 reasons why Indian investors should look at it. They may not be the reasons they are looking at it, but I think there are reasons they should look at it. Those 3 reasons, in my view, are: 1, diversification. Different markets do well at different points in time. I mean, China is the best performing market this year, right? Everything said and done, China is the #1 performing market this year. US is the best performing market over the last 10 years. Can you really predict which market is going to do well? No. So there is a great case for diversification. The second case, in my view, is currency. You know, our currency does depreciate 3-4% a year, and that is something to keep in mind. And third, as I said, is access to a lot of things that you just don't get in India. I mean, in India, technology for you means some of the large outsourcing bellwethers. But we also know that we're living in a post-COVID world where some of these themes like AI and artificial intelligence and streaming are going to become big, and they are not represented in your local home market portfolios. So I think those are the reasons people should look at them. And it is a good step that they are starting to take that move.
Fair points. And I mean, just to put some data, behind what Radhika just spoke, if you look at the US S&P 500 and you look at the correlation with Nifty 50, if you look at the home currency basis, so if you look at S&P 500 in US dollars and Nifty 50 in INR, the correlation is 48%. So not a lot of correlation there because, of course, equity markets have a global push. But once you take it in the same currency, so basically you look at S&P 500 in INR and you look at Nifty 50 in INR, the correlation drops to mid-20s, which is actually a great diversifier. I mean, that negative correlation and positive returns is just good examples in theory. You rarely find them in practice. If you can find two assets that have good expected returns and about low 20 correlations, and then that adds a lot to your portfolio. So to Radhika's point, that in itself is the biggest reason why people should think about international investing.
So I have a question for you, Gaurav. It's so like if you're sold on the merits of international investing,
right,
what do you think is the best way to go about that? What is the best means and channels to do that through?
You should go with something that is the easiest for you. I mean, I maintain that if investment is not your day job, right, then the only way to be a successful investor is to take the path of least resistance and to make the least amount of errors. What this means is look at international ETFs, international mutual funds. I mean, there is an S&P 500 index that's listed now. There's a NASDAQ index and ETF listed now. There are a bunch of international funds that have been around, and I'm pretty sure Radhika can talk a bit more about that. So they are an easy way of getting this international exposure if that's the path of least resistance for you, right? If you're someone who spends 6 hours, 7 hours every day analyzing stocks, analyzing global markets, then you can do single stocks as well. We don't take sites based on, single stocks are better or portfolios are better, because eventually you are also going to build a basket of 20, 25 international stocks, which will be your international portfolio. Instead of having a fund manager, now you are the fund manager of your unique portfolio. You're not going to be investing in only 2 international stocks. That is an absolute no-no. If you're working for an international company and you get their ESOPs, first thing you should do is you should diversify those ESOPs, right? Because maybe you get lucky and maybe, you're on a, maybe it's Google in 10 years, fantastic returns. It could as well have been a bunch of other companies that we know where the ESOPs went worthless fairly quickly, right? So it's the path of least resistance. If it's not your day job, then get professional help. If you're really vested in it, then yeah, you can do single names as well.
Do you think that post-COVID, I mean, maybe Radhika as well, do you two think that post-COVID, the way people invest overseas might change a bit? So for example, maybe before people might have gone more towards passive funds and tracker funds, and maybe now, will there be a bias towards active managed funds, even if it's not people individually doing that, but towards active managed funds, because the world is so uncertain now that it's one thing to say, okay, we're going to buy the EM index, but that's a big universe, and there are going to be some real disasters in there given what's happening at the moment.
So, Una, my perspective on this is from an Indian investor's point of view, it's a little more premature just because international investing for us has been such a small part. I mean, if you take this numerically, the assets of domestic Indian equity funds are to the tune of about 8 lakh crores. That's about 800,000 crores. The international asset base of equities is 3,000 crores. I mean, it is such a small number that we haven't even dabbled. So I actually think the whole thing about whether you do it actively or whether you do it passively is very premature, because a majority of our investors are just beginning to discover that this category exists. As Gaurav said, single stock is an option, but it's hard enough to do single stock. And I know I carry a bias because I'm a mutual fund manager, but it's hard enough to do single stock in India, where you understand the stocks and you understand the markets, to try and pick a portfolio. I mean, if you're going to hold 5 stocks, in any case, as he said, that's fairly risky. But to try and pick a basket of 30, 40 international names and track each of them and track each market, in my view, I think is pretty difficult. I think what people are starting to do as we're having those conversations is people are starting to look at themes they find interesting. I think the first thing they do is run to developed markets. So that is a common one. China is a theme that I have seen a lot of interest in, just because people realize that if you're looking at consumption as an opportunity, that's another one. Technology broadly, whether it's an active fund or whether it's a passive fund, is another theme that feels close at home to people. So I think, it's a little focused in choices, and they're trying to look at something that you can't get out of India. But active, passive, how I do it, probably less relevant in a context where people are just learning that I have to do this.
Very fair points, Radhika. In your opinion, right, again, at what stage of an investor's journey should they start thinking about international investing? I mean, do you think that, say, if I'm a new investor, right, I just started investing, I opened a demat account or a mutual fund account or one of them, should I go right into international funds? They've done the best in the last 3 years, or should I say, hey, you know what, wait, sooner or later, the biggest chunk of my portfolio will be domestic equity. So at what point is there a, do you think there is a kind of, like experience hurdle that needs to be there? Is there a wealth hurdle that needs to be there? How do you contextualize this?
I think it's a very good question, because what does happen is, because the last 3 years, and I get scared sometimes with some of my own funds when you show the performance of these international funds. I mean, in the last 10 years, I'll give you an example. NASDAQ or US tech as a theme has not had a single negative year. Now that is very scary as an investment professional to show an investor, because they're going to start investing believing that this will never lose money. When, by the way, I mean, you talked about risk return, Gaurav. The technology funds or any of these themes, whether passive or active, are actually far riskier than your Indian equity investments. So I think there is an evolution that definitely needs to happen. I think as an Indian investor, you first need to get your basic equity and fixed income right. Now, this doesn't sound like glamorous advice, but you need to get that right, diversify there, and then move on to your international investments, gold, other allocations, etc., etc. Because remember, you understand Indian markets, you understand this. You don't understand tomorrow if you're international. If you invested in a China fund as your first investment, okay, and it was down 30%. Versus an India fund down 30%, I can tell you, you would be far more panicked about your China fund being down 30% because you do not understand China the way you understand India. So I think it's not about wealth, but about an asset allocation stage of evolution. Get your basics right, yeah. Get your, as we call it, dal chawal in India, right, before adding condiments to the platter. I think that's important. One approach I think people can do, which I have been doing since 2011, is, SIP has been a big culture for us. You do an SIP into an equity fund, you do an SIP into a debt fund, do a small SIP into an international fund. That way you gradually build your international allocation and your domestic allocation.
It makes a lot of sense, actually, to be very honest. I think there is a recency bias, and I think that's exactly what you're saying. And it's not just that there's a recency bias for international funds, right? Even within India, go back 2 years, there was this massive recency bias for small cap funds, right? And in the next 2-3 years, there'll be a recency bias for something else. I mean, right now, everyone's talking about investing in pharma and buy pharma, sell banks. But as Radhika, you've rightly said, if you look at the long-term histories of any sectoral investing, the long-term returns are not that much better risk-adjusted versus an index, unless you're able to time those sectors. And timing those sectors is equally hard. If you could time the sectors, you might as well time the index. So, fair point, very well taken. Sorry,
if you're, I mean, exactly, like, and this is the one thing that concerns me, is if you suddenly have a lot of people in India suddenly looking to invest overseas. You've both talked a little bit about the attractions of the China story or the US story. And I mean, actually, sort of the big elephant in the room here is that these two markets are at loggerheads at the moment. There's sort of unprecedented amount of geopolitics going on in a way that could really profoundly affect the performance of US companies because of their sort of large exposure to China. I mean, we've got sort of like, US Secretary of State yesterday declared that Hong Kong is no longer autonomous from China. And that's a political development, but it actually has huge business ramifications. So are Indian investors looking to go overseas at a particularly difficult time with COVID and this extreme geopolitical sort of head fighting between two of the world's biggest economies?
I can give it a shot, right? I mean, see, at any given point in history, right, there are always look ahead risks.
Yeah.
When we look back, we only see the risks that manifested. We don't see the risks that never manifested. So simply put, right, I mean, there is always this chance that a cold war will break out, or something will convert into a hot war, right? Thankfully, the probability that it happens is really, really low, and we would like to leave it like that, right? We don't want a lot of hot wars. We don't want a lot of cold wars either, right? Is the situation escalating? It is. Has it escalated many times before and then just resolved itself? It has. I mean, I'll give you a very recent example in the oil space, right? For 3 weeks, people were writing oil off. Like nothing can be done. These two parties will never come together. These is deep rooted. Russia doesn't like Saudi Arabia, US. That whole it was geopolitical. Of course, there's a lot of conspiracy theories on exactly what is going on. But honestly, no one really knows what's going on. And then all of a sudden, right? Like no pre-warning, no news. It just normalizes. Oil's back above 30 plus. Plus, we don't know how long it normalized for. So the larger point is, I think it's very difficult to quantify some of these risks.
I think that's right. But as someone who spent the last before I've been here for 3 years, but before I was in Bombay, I was in Hong Kong for 4 years. And as someone who sort of watched that story quite closely over recent time, I really feel like it has escalated to a sort of point of real concern. So I think that, coupled with this idea of markets, which Radhika was talking about, like sort of that domestic narrative focus, that sort of insular focus that we're bound to see more of in the world. I think that sort of, I wonder how much that has to play into the way people invest.
So I would just make one point on there, is that I just feel that you never get the perfect set of circumstances geographically, or even in your local market as an investor. I think there are times when, if you look at 2 years ago, I think everything looked locally perfectly, but the fact is that valuations were super expensive. So I always tell investors, you'll never get the perfect combination of low valuations, perfect politics, stable geopolitics. It just doesn't come, right? There is no free lunch in the business that you're in. And I think, Gaurav also made the very nice point that geopolitical developments and economic developments are so volatile and so hard to predict quarter on quarter, which is why my approach has been just have an allocation, locally and have an allocation internationally. So when people ask me, should I invest internationally? I said, you shouldn't do it now because it's getting exciting and glamorous. Now you should have had that allocation for 10, 15% of your portfolio and hold that allocation constantly. And if you're making the allocation, have the confidence that, if there is a crisis, if there's a crisis in India, most equity investors hold their allocation. If there's a crisis in the US or China, please invest knowing that you will hold that allocation for the same 3 to 5 years. You invest in Indian equities with a 5-10 year horizon, right? Even in another market, you've got to have the same time horizon because you're investing in equities at the end of the day. The asset class doesn't change.
Yeah. I think you're completely right. I think you're completely right. For the geopolitics, it does feel very loud and noisy and messy at the moment. But I think if you hold that, history has shown us what kind of returns that can produce over the longer period. But I think people just have to go in knowing that you have to take that same approach.
The other thing, right? And this is it's a pretty morbid point to make. See, I hope it never happens, but the next hot war will be a global war. I think it'll matter less where you're invested. Trust me. It's the way things are going, right? Everything is so interconnected.
Yes.
The possibility that you can have a skirmish, it can happen between smaller economies, right? So if there's an India-Pakistan border skirmish, that's okay. That can continue. But if any of the larger economies get involved, it's very hard for it to be contained. So, the outcome for all of us then becomes dramatically like, literally how much physical gold you have. going back to our age-old Indian investment philosophy. Do you own your house? Do you have physical gold? So, uh, uh, but I mean, it's a morbid thought, but I think that's how I would see how things are actually playing out. So we don't actually spend too much time on geopolitics, to be very honest, right? I mean, it's also because Radhika said it, and I'll say it again. I also find it very hard to kind of link it to any kind of investment decision.
Yeah.
It's just really, really difficult to get your head around it, because you never know what the true picture is. You never know how quickly these decisions change. And in recent times, like, you've rightly pointed out, it's a very loud space, because we have a US president who is, of course, very loud, right? And China,
and on Twitter.
On Twitter, right? And Chinese have this internal pride. They can't back down. They have to save face, right? So that's very important to them. But you don't know how much of this is just pretense and just kind of, like you see on Discovery Channel, two males fighting for territory, or rather than just showing off on how strong they are, but not actually ever fighting. So not a very good analogy, but I think you get the picture. So long answer short, I think geopolitics is very hard to figure out. I mean, and I've lived in Hong Kong, like you were there, and we left Hong Kong in 2016, and we really loved Hong Kong, right? And we were quite sad to leave Hong Kong. But 2 years later, now we have friends in Hong Kong who are now saying, hey, are there opportunities in Singapore or in India? Because they see the day-to-day deterioration there, and it's very hard to call these things.
Yeah, I would totally agree with that. I mean, I think at the end of the day, it's really important to invest in markets where, they're deep, they're liquid, that, if all hell does break loose, you can get out. And when I look across the emerging markets, it's funny because some of those markets that have like strong, bad public finances are actually some of the most tradable, like Mexico, right? It's the world's most traded, currency, emerging market currency. So it's just, it comes and goes.
True. And since both of you've lived abroad, and I can happily call you global citizens. So just a quick question before we end. How do you think about your investments? How do you split them between India and international? How do you answer this question for your own finances?
So for me, and it used to be different when I lived in the US, because I think about 50% of my portfolio was US and 50% was rest of the world, and a significant amount was emerging markets. Now sitting in India, I have to confess, over time, my own portfolios have become far more conservative, because I realize I'm in a very high risk profession, that is asset management. And I'm also married to someone who's in an extremely high risk profession, that is asset management. So our portfolios have a fair amount of debt. We have Indian equities, but we have had international equities since 2011. We moved back in 2009, discovered international mutual funds in 2011, long before I became an AMC head. And we've been holding, broad international funds since 2011. We don't change them too much. I mean, we just hold the markets and we think of them. And just like we do an SIP into domestic funds, we do an SIP into international funds. So we think of them as a part of our allocation, and that's how life is.
Fantastic. Una?
Well, I do invest regularly into a sort of managed fund that has exposure assets all over the world, but it's very much at an arm's length. And that's because I work for Reuters, which means that as a company, we adhere to the trust principles, which means we don't have any conflicts of interest with things we're writing about. But I do really believe in that sort of long-term, consistent, for better or for worse, just keep going. And, ultimately it will all come out in the wash. And if you can kind of afford to do that, then that's still the best way. And then obviously I think, my father drilled it into me from a young age that property was very important. And I don't really like being leveraged. I'm not, and I feel particularly great about that in this environment. So yeah.
That's fantastic. I think there are advantages of property as well, even though it's not been doing well. But I think in the long run, people will realize,
well, of course, the property dynamics are very different in London, where I am from originally, than India, or Bombay specifically. So, yeah.
Perfect. So that was fantastic. Thanks, Una. Thanks, Radhika. Thanks for coming. and sharing your views about international investing, about how India fits into the larger global space. Will the liquidity that's sloshing around, will that come to India? Should Indian investors think about international investing? If I can summarize really quickly, I think bottom line is asset allocation matters, have an international exposure, keep it steady, don't try and chase recent returns, and try and be a long-term investor. I think all of them are fantastic advice. They're timeless, and I think they're true for any and every asset class. So thanks again, Radhika. Thanks again, Yuna. Great to have you.
Thanks. Thanks.
Thanks, Gaurav. Thanks, Radhika.